Welcome to the Riskwiser Zone, the podcast where we dive into the world of stocks and finance to help you make informed decisions about your investments. I'm your host, Lewis, and I'm excited to have you join us today. We're starting off with a look at the current market trends, and there's been some significant movement in the defense sector. Tensions between India and Pakistan have been escalating, and this has led to a surge in defense stocks. Companies like Paras Defense, Cochin Shipyard, and Hindustan Aeronautics have seen notable gains, with some rising by as much as 11%. Now, it's essential to remember that geopolitical tensions can be unpredictable, and it's crucial to approach these developments with a level head. While some analysts believe that companies with strong financials and execution capabilities will benefit from the government's efforts to boost indigenous defense manufacturing, others are cautioning against aggressive buying at this stage. We'll be taking a closer look at the implications of these developments and what they might mean for your investment portfolio. It's also worth noting that India and France are set to formally announce a deal for 26 Rafale M fighter jets, which could have further implications for the defense sector. As we navigate these complex issues, it's essential to remain balanced and informed. We'll be discussing the potential risks and opportunities in the defense sector and exploring what this might mean for investors. We'll also be examining the broader market trends and how they might impact your investments. From the latest news on the economy to expert analysis and insights, we've got you covered on the Riskwiser Zone. So, stay tuned as we delve into the world of stocks and finance. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're glad you're still with us as we dive into the world of finance and risk management. In our middle segment today, we're going to explore a story that's been making waves in the global economy. As you may have heard, the U.S. has imposed tariffs on goods imported from 180 countries, including India. This move has sparked fears of a global trade war and has sent shockwaves through the markets. But what does this mean for investors and businesses? According to Chakri Lokapriya, a seasoned expert in the field, the Indian government is among the 6 countries that have offered concessions on U.S. imports into India, which could be viewed positively by the Trump administration. However, the 90-day pause on tariffs has created uncertainty, and companies are likely to remain cautious until the new tariff rates are finalized. This caution is expected to lead to a 3-5% earnings cut for FY26, with corporate India potentially putting new capital expenditures and expansion plans on hold. But what about sectors that could benefit from this situation? Lokapriya suggests that domestic sectors such as financial services and consumer discretionary could be considered for incremental investments, depending on one's risk appetite. It's also worth noting that investor bearishness is at its highest since March 2009, with many investors choosing to remain liquid and deploy capital on correction. And when it comes to small and mid-caps, Lokapriya advises focusing on companies with strong earnings outlooks, regardless of their size. As for foreign institutional investors, they're likely to return to India once they see evidence of earnings growth revival, which could be at least a couple of quarters away. Interest rates will need to fall further in India to aid as a growth catalyst. So, what can we take away from this story? The key takeaway is that the current market situation is volatile and uncertain, with many factors at play. As investors, it's essential to stay informed, be cautious, and diversify our portfolios to manage risk. Stay tuned for our final story of the day, right here on the Riskwiser Zone. Welcome back to the Riskwiser Zone. As we wrap up today's show, I'd like to dive into a fascinating story that highlights the ever-changing landscape of the mining industry in India. Our focus is on Hindustan Zinc, a Vedanta Group company that has been making waves with its expansion plans and impressive financial results. As reported by the Economic Times, Hindustan Zinc has announced its foray into potash mining with plans to explore a block in Rajasthan that also holds potential lithium reserves. This move is significant, given India's heavy reliance on potash imports from countries like Russia, Canada, Belarus, and Israel. By reducing its dependence on foreign imports, Hindustan Zinc aims to capitalize on the growing demand for critical minerals. But that's not all. The company has also been awarded the Dugocha Gold Block in Rajasthan, expanding its portfolio of precious metals. CEO Arun Misra has stated that Hindustan Zinc will continue to explore and expand into other critical minerals of strategic interest, including tungsten, which they've already secured a block for in Andhra Pradesh. Now, let's take a closer look at the numbers. Hindustan Zinc reported an impressive Q4 result with a better-than-expected EBITDA of Rs $47.8 billion. However, while Nuvama has lowered its FY26 and FY27 EBITDA estimates by 5.4% and 3.7%, respectively, citing lower expected zinc lead and silver volume growth. As an investor, it's essential to consider the broader implications of these developments. On one hand, Hindustan Zinc's expansion into critical minerals could provide a significant boost to its revenue and profitability. On the other hand, the company's reliance on commodity prices and regulatory approvals may pose risks to its growth prospects. As we conclude this segment, I want to emphasize the importance of staying informed and adapting to the ever-changing market landscape. Whether you're a seasoned investor or just starting out, it's crucial to weigh the pros and cons, assess the risks, and make informed decisions. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe. And until next time, invest with caution.